We haven't hit a clear-cut recession. We've had rolling recessions, certainly housing and autos, manufacturing, and so forth, but we haven't hit the big one, the recession. And in fact, what's happening, to many people's surprise, is inflation is coming down faster than they have expected. A lot of people were of the view, like Larry Summers, and I think he's still there, that we are closer to a 70s style inflation than most people think. We disagree entirely. And I think many people who follow Larry and others are surprised to see inflation coming down so quickly.
Despite more than a year of widespread warnings that recession was near, America's economy is, if anything, accelerating. Even as the Federal Reserve has sent borrowing costs sharply higher, the economy's resilience has been on plain display. Consumers keep spending and employers keep hiring. Inflation has reached its lowest level in 2 years, helping Americans stretch their paychecks. The government estimated Thursday that the economy expanded at a solid 2.4% annual rate in the April-June quarter, an unexpected pickup from the 2% pace in the first quarter. Businesses helped drive the growth with robust investment in equipment, software, and buildings. The latest snapshot of the economy coincides with the rising sentiment that it may achieve an elusive soft landing in which growth slows and inflation falls without igniting a full-blown recession. The most optimistic economists say they're growing more hopeful that a recession can be avoided, even if the Fed keeps interest rates at a peak for months to come. Many analysts have been encouraged because some threats to the economy haven't turned out to be as damaging as feared, or haven't surfaced at all. The fight in Congress, for example, over the government's borrowing limit, which could have triggered a default on Treasury securities, was resolved last month without much disruption in financial markets or discernible impact on the economy. And so far, the banking turmoil that occurred last spring after the collapse of Silicon Valley Bank has largely been contained and doesn't appear to be weakening the economy. Let us join Cathie Wood as she shares her macro outlook, discussing monetary policy, fiscal policy, and various economic indicators. As you watch, make sure to like this video, subscribe, and drop your comments below.
We got a downgrade. Fitch downgraded government debt this week. And some economists are treating that with alarm, and others, including strategists, are treating it with a yawn. And the truth is probably somewhere in between, as is usually the case. It really is a sign that our spending, the government spending, in the last 5-6 years has just been out of control. And my reaction to it is, hopefully this is a warning to the legislature and politicians generally that, the spigot is going to have to stop. And it's interesting, as I look in the GDP accounts at the government line, it's actually shrunk as a share of GDP, and most of the spending is not in the GDP report. GDP is production of goods and services in the U.S. economy. And a lot of the spending has moved off into social programs, which are not part of GDP, like, say, defense would be. So I think that topic is going to gain a lot of currency. Maybe they'll skip through it over the election year and campaign season, as they usually do. But I do think Fitch is warning us that we're going to have to deal with this issue in one way or another. Our point of view would be enact policies that encourage very rapid growth, because we're on the threshold of some technologies, as you know, we talk about them all the time, really turbocharging growth. And the best way to get out of a debt problem is to grow out of it. So that's one thing. The other thing that happened that was kind of interesting from a fiscal policy point of view, especially now that we've entered the election campaign season, was movement on crypto legislation in the House. Now, we don't think it will get out of the House because Maxine Waters is head of the Financial Services Committee and is not pro-crypto. But crypto, or as Art Laffer would say, could you please use a different word like digital assets legislation? We do think that it will become an election year issue. And the fact that it's even stirring in the House at this point in time and becoming a conversation, we think is going to work to the benefit of crypto. And what's very interesting is, whereas we thought we had a bipartisan issue in crypto, the side seemed to part, especially with Elizabeth Warren siding with the banks, interestingly and unbelievably, that we need to be very careful in this realm. We should not trust it. So we thought there was a partisan divide evolving, but we are seeing some Democrats coming back to these bills. There were two that were voted. Well, one has been voted on already, and it got 6 votes from the Democrats. And the next one, that one was on market structure. The next one is on stablecoins, and apparently that will have many more than just 6 votes from the Democrats. So this could become, yet again, a bipartisan issue, which we think it should be. Innovation solves problems, and this crypto legislation would really put in place the layer of the internet that no one contemplated in the early days of the internet, because it simply was a place to exchange information. Nobody thought about commerce or financial services.
Analysts point to 2 trends that might help stave off an economic contraction. Some say the economy is experiencing a rolling recession, a circumstance in which only some industries shrink while the overall economy manages to stay above water. Others think the nation might have experienced what they call a rich session. Major job cuts, they note, have been concentrated in higher-paying industries like technology and finance, heavy with professional workers who generally have the financial cushions to withstand layoffs. Job cuts in those fields, as a result, are less likely to sink the overall economy. Still, threats loom. The Fed raised its key interest rate on Wednesday to about 5.3%, its highest level in 22 years, and may do so again before the end of this year. Those rate increases impose heavy borrowing costs on consumers and businesses. That's why some economists caution that a full-blown recession may still occur.
About this period of time, and while I have always thought it was characterized by booms and busts, and it was, what Art says is those booms and busts happened very quickly, 6-week periods of time before they'd clear up. The booms and busts that have evolved since the Fed took control have been many years in the making, and then when they happen, they are extremely destructive. So just putting in a plug for that. Anyway, on monetary policy this time around, Chairman Powell, in his testimony to Congress, basically used the word restrictive to describe monetary policy, which is a big step, I thought at least. And he wasn't thinking about it in terms of the money supply. And as you know, we've been talking about the money supply falling on a year-over-year basis. And in fact, if you go back into 2021, you'll see that the money supply really hasn't gone anywhere in 2 years. This is extremely unusual and negative year over year, as I've said on all of these calls, since M2 growth turned negative early this year. That we have not seen since the 1930s. And we've also seen a collapse in banks' willingness to lend. They're very worried about the health of the economy, and they're facing even more capital restraints, we've learned in recent days. So monetary policy is restrictive, but Chairman Powell was referring to real rates when he said that. So the Fed funds rate is at roughly 5.5% now. And CPI inflation, that's headline inflation, is 3%. That's 2.5% real rates. And if you look back, you'll see that rate, that real rate, 2.5%, was the peak right before 0809. So that's somewhat concerning. But more concerning to me is that the inflation rate is coming down so rapidly now that what if we're at 5.5% on the Fed funds rate and 0 on inflation by the end of this year, which we believe is a real possibility? That would be a 5.5% real rate. And we haven't seen those since the 80s, when the Fed was all about fighting the return of double-digit inflation. That's not where we are right now. So I think that what's going to happen in the next few months, as inflation continues to come down, is that more and more people will be talking about this real rate, which is really starting to mount. And I think it was healthy to hear Chairman Powell refer to monetary policy as restrictive. So half of the solution is understanding the problem. If he thought monetary policy was still too easy, that would be a big problem.
The job market has cooled over the summer, but it's still strong enough to defy predictions that higher interest rates would tip the United States into recession. U.S. employers added 187,000 jobs last month, fewer than expected. But the unemployment rate dipped to 3.5% and a sign that the job market remains resilient. Hiring was up from 185,000 in June, a figure that the Labor Department revised down from an originally reported 209,000. Economists had expected to see 200,000 new jobs in July.
As has been the case for the last, year and a half almost, other measures of employment are contradicting the non-farm payroll. This time it's household employment. Household employment was negative, I think, in May, to the tune of 300,000, but it's coming back, and it was up 268,000. So lots of cross currents. But one thing we are seeing, and I think is really important, is the average work week is going down. So it went down 0.3% in July. And what that tells us is that companies are still hoarding labor. They're afraid to let employees go because they had so much trouble attracting them in the last couple of years, especially in and around COVID. So I do believe that they're going to face severe margin pressures as they hoard labor, and their pricing power diminishes even more. So I believe that the average work week has not been this low since at one point in 2020 during COVID. So that gives you a sense of the labor hoarding. The employers don't want to lay people off. They'll just give them fewer hours to work. Average hourly earnings were up 0.4%. That was a little higher. Again, the Fed's watching that. Others who are very focused and remember the 70s style inflation are focused on wages, because wages went up and pushed through into inflation.
When different sectors of the economy take their turns contracting, with some declining while others keep expanding, it's sometimes called a rolling recession. In that way, the economy as a whole manages to avoid a full-fledged recession. The housing industry was the first to suffer a tailspin after the Fed began sending interest rates sharply higher 16 months ago. As mortgage rates nearly doubled, home sales plunged. They're now 19% lower than they were a year ago. Manufacturing soon followed, and while it hasn't fared as badly as housing, factory production is down from a year earlier. Affluent Americans aren't exactly suffering, particularly as the stock market has rallied this year. Yet it's also true that the bulk of high-profile job losses that began last year have been concentrated in higher-paying professions. That pattern is different from what typically happens in recessions. Lower-paying jobs in areas like restaurants and retail are usually the first to be lost, and often in depressingly large numbers. That's because in most downturns, as Americans start to pull back on spending, restaurants, hotels, and retailers lay off waves of workers. As fewer people buy homes, many construction workers are thrown out of work. Sales of high-priced manufactured goods, such as cars and appliances, tend to fall, leading to job losses at factories. This time, so far, it hasn't happened that way. Restaurants, bars, and hotels are still hiring. They have been a major driver of job gains. And to labor market experts, construction companies are also still adding workers despite higher borrowing rates, which often discourage residential and commercial buildings. Do you think the U.S. economy will avoid a recession? Drop your answers in the comment section below, and don't forget to like, subscribe, and turn on notifications. Thanks for watching.